Robert Butler. Are you there?
Yeah, I'm here.
Okay, so Robert's a guy who I've known for many years. Usually he's seated out of Austin, Texas, which I understand is the new home of Elon Musk.
Well,
As of today.
Welcome him.
I'll tell him you say hello. Are you in Arizona today? What's going on with you? And why don't you tell us about who you are, what you do, and then introduce your group.
All right, so I'm currently in Tucson. I'm hiding out at my parents' house during COVID, but I guess now that Elon's in Austin, I better make my way back there. I started doing these events with Marty back in 2011 when I was working at a small hedge fund where family offices were our best clients and prospects. But I know we've got a big panel, so I'm hoping everyone can give a brief intro on who you are, where you are, and if it's not where you normally are, that'd be great to hear. And then since our panel is family office deal making, would love to hear how you work with family offices in deal making, and if you have an area or asset class of focus. And then after those intros, love to jump into a bunch of questions, and hopefully we can be pretty interactive. And I guess, I'd love to go ladies first. Carol, kick it off with you.
Great. Thank you, Robert. Hello, everybody. My name is Carol Pepper. I'm the founder and CEO of Pepper International, a family office consulting firm and external CIO firm that I founded in 2001. And I can't believe that next year my firm will be 20 years old. I manage and advise over $1 billion of assets for several very large single family offices. I work globally with families all over the world. And how I work with deal making is I am representing my families when they want to make direct private equity type or seed or venture round investments. We have a great deal of focus on social impact, technology, healthcare, and really cutting edge research. So we have people that are not afraid to put in the seed round money, which is always interesting and is something that a lot of the next gens are interested in. So I'll talk more about that later. But it's great to be with all of you. And my website is pepperinternational.com for those of you who don't know me. Thank you.
Well, and maybe Barry, you could go next since we had a call recently. I'll let you give your little intro.
Yeah, thank you. I'm in Boca Raton, Florida now, although I also live in Manhattan. Physician by training. My family office is based in both Manhattan and in Boca. Clearly, we're all virtual. My initial wealth was created in medical rehab centers throughout Florida. My partner is a very famous neurosurgeon. Subsequently, I had another exit with a company that I substantially invested with that we sold to Deutsche Bank for over $1 billion. I was on the board, and we've been very lucky. Since then, I've just been making investments, and I'm pretty global with a very, very large generalist opportunity in investments.
All right, and kind of going across my screen, it looks like I've got Rick, you're next. Oh, I think you're muted.
Hold on a second here, let me investigate. No, Rick is on.
Rick isn't muted.
Oh, well then for some reason I can't hear him. That's strange.
Yeah, I can't hear him either.
Neither can I.
Same here.
All right, well, let's go to Dino, then we'll maybe come back.
All right, hi, Dino Orlandini. I'm Managing Director for Scouting Capital Advisor. We are an Italian investment banking firm. We do corporate finance, and we have a family office practice as well. And within the family office business, we cover also some direct investments of our, let's say, of our clients. I'm based in Miami. I have a background in investment banking. I spent over 20 years at Banco Santander in New York, and I was heading the M&A department.
All right, thank you. And Mauro, how about you?
Hello, everyone. My name is Mauro Andriotto. I am an adjunct professor in finance in Italy and Switzerland. I teach at Bocconi University, Milan, University of Pisa, and the University of Geneva. I have different roles. One, I am an equity partner of a pretty big family office. The name is SMC. We have 15 physical locations around the world, in particular in Russia, Middle East, Switzerland, and South America. I'm also an equity partner of Etica Capital, that is a new company, a new asset management firm with a particular focus on crypto and fintech. I am also an advisor of the European Commission. I am a jury member of the European Innovation Council, and I help the European Commission to select and fund innovative projects and small medium enterprises around Europe. And I'm also an advisor of the European Institute of Innovation and Technology, that is another big commission inside the European Commission for the financing of innovation around Europe.
All right, and then let's try.
Robert, can I just interrupt you? I think you're getting to, Rick Stone, are you there? Rick, I can see you on the camera, but I can't hear you.
I don't know why.
Oh, now you're
Oh,
here.
now we can hear
Perfect.
All right.
Now I can hear you.
Okay. So that woman is not Rick Stone. I am. No, Carol is not. And I have my own family office in Jupiter Island, Florida. And I also run a group called Palm Beach Investment Research Group, which is a group of 35 family offices who meet now virtually twice a month to vet investment ideas. We've been in existence since 2008. We've had 600 presenters. People make individual investment decisions, but we share the due diligence process. And we have people who have expertise in various areas of investment that makes it, enables people who don't have that experience to make more informed investments with respect to different managers.
All right, I know we had a big panel, so I hope I didn't miss anybody. But, since we got a deal making panel, to me, we're not really starting at the asset allocation stage, but I think a good place to start would be to hear about how you go about sourcing investment opportunities and how that has changed from pre to current COVID, and if you see any of these changes standing, post COVID, whenever we get there.
Hey, Robert, can I just jump in here 1 quick second? I really want to get a quick 1 minute economic outlook for 2021 from everyone. I always love getting Rick Stone's macroeconomic viewpoint. So if Rick can just tell me where he's at in terms of the economy and modern monetary theory, that would be great. And then if everybody can lead into why they're doing direct investing, that would, or how they're investing, that'd be great too. So Rick, are you there? Rick Stone?
I'm there.
Can you just give me your economic outlook and MMT, et cetera?
I very much feel like I'm the only person in a room often today, especially today, given the IPO and the pop that took place. We have traditionally not been stock market investors, and our group of 35 family offices have not been stock market investors. We've operated primarily in the alternative space, but more so now than ever because we have no ability, despite the fact that many of us, including me, have gone to Columbia Business School and Harvard and Stanford, to value companies. We have none of the traditional landmarks, multiples of income, moats around their business, proprietary business. The factors that we learned, I realize I'm old now, but I'm not that old, in terms of valuing companies and whether they'll trade in the public markets and whether they'll succeed in the public markets, have very, very little observable relevance in today's marketplace. And so we see deals that we don't think will ever be profitable, whose revenue is speculative or based upon factors that may or may not exist in the future, labor laws, local governmental laws, easy competition, trading at enterprise values greater than successful standard businesses that do well except in a deep recessionary market. So we're having a very hard time in the public markets making any judgment as to what's fair value. And I guess what we find most surprising is sort of that that whole enterprise exists without many naysayers. I know there are always people who disagree with everything, but the level of agreement in the investment community with valuations that we think are not only unprecedented, but without any economic or financial analysis foundation is, I guess, shocking. So I say this to my group, 35 family offices, that's my position. Everyone's entitled to their own position. And I'd say some people agree, some people don't agree, but most people don't care because their position is, you're right, we don't know what valuations are anymore or what valuation should be. There's no predictability, but we see stocks that have revenue growth trading at 30 to 40 times. So we may buy companies that are trading at 20 because they may go to 40, not because we think that has any sound financial basis, but because we've seen it happen before. And that exists totally apart from the private market deals that we typically do, and the trading strategies that we typically engage in, where we're still working hard to get 8 to 15% returns, depending upon the level of risk. So it's been an incredibly unusual, I don't want to say interesting because I don't find it interesting at all, I find it astounding, marketplace where people who are betting on other people's predictions of the market are making money, and people who are relying upon fundamentals that have driven market valuation since World War II are not making money.
I think you feel like John Belushi at the end of Animal House, where you're saying value investing dead, fundamental investing dead. You know, Robert Butler is a CFA. You know, the fundamentals you learn as a CFA, they're not in place anymore, but momentum's for real, right? So I'm hoping that others here can talk about, you know,
Yes.
why they're, okay, I'm sorry.
The other day, one of our panelists compared value investing to leeches. So yes, I agree with you.
I bumped on your head. There you go. Right.
Well, and I would think a lot of the panelists are kind of in agreement. I mean, maybe that's why people are focusing on, you know, more of the private deals. Maybe you can control more of the aspects. So unless anyone had any more global thoughts they'd like to share,
Just keep on moving.
you know, I'd like to hear, you know, maybe Carol, start with you again. You know, if you could share a little bit of information on how you typically source investments and if that's been changing, you know, during COVID, and if you see any of those changes persisting in the future.
Well, I have been in the family office world in my own firm for 20 years and in the finance world for over 30 years. I found that most of my good deal flow comes from other family offices. That's always been the case. I have a good close network of family offices that I love and that we speak regularly. So that has continued, and I'll, you know, later on, I'll be happy to tell you about a deal we did during COVID, which was very interesting, and in fact, maybe interesting to other people. I think it's a fantastic deal. Looking at all the trends that we're facing now. We all know what these trends are. You know, everybody working remotely, the world just basically changing, less travel, that most likely these things are not going to change when we go back. The need to focus on healthcare and technology in every single industry to change how business is done. And those that have changed faster or in the sweet spot saw their valuations boost up on the public market. And on the private market, there's a surprising number of people that are actually very actively looking not only for sort of distressed real estate, which is an obvious area to look right now and will continue to be an obvious area of the next few months, but you know, great seed startups, tech innovations, things that were cooking, but now are even more likely to pop because of the global changing habits of consumers. It's not just the US, this is true all over the world. So what I've seen change is how you do due diligence, because you can't necessarily, maybe you see a great deal in a place where you can't literally get to. Before we'd all jump on a plane, I mean, last year I was on a plane 300 days a year. In the year, but not this year. I've been grounded since March 1st. So doing due diligence is a very different activity now. And frankly, expanding the network is more frustrating now of other family offices. So I'm very glad to also connect with all these panelists and anybody out there. You know, I have families that are very actively looking, and I don't trust deals that come in from brokers, or I get a million cold emails, which don't really work. I have a process on my website if people want to send me investments, but many people don't try to bypass that process. It doesn't work. But from people that I know and trust, I think that's the key, to find people that you have done business with before, know you, know your families, and I found a lot of interest with the younger next gens now. The 25-year-old girls and guys who got out of college, they're kind of stuck at home because of COVID. They can't do much of anything. And they're actually very interested in some of the startup and seed rounds, which is a good place for them to get started. They can do a lot of work online and get involved with the companies.
All
So
right.
that's what I'm focused on.
Any of the other panelists have anything to add? I mean, I would think, I mean, most of us are trying to use usually our existing network and partnering with other family offices. And obviously, yes, the due diligence is changing when you can't sit down and go kick the tires. So I'd love to hear from the rest of the panel on, any other, maybe unique ways that you're sourcing opportunities, or any ways that you found to sort of get over the lack of travel during COVID. I mean, are you doing Zoom due diligence, or having someone walk around a factory with their iPhone doing FaceTime? So I kind of open that up to whoever jump in.
I'll jump in real quickly, because I've been, at first when COVID started, I looked at those companies, especially in the healthcare space, which I'm heavily involved in, where I can re-up in investments that I previously had made.
Mhm.
When I realized that wasn't working, then my next course was, and I have a wonderful office staff that really went out, and I'm probably a little bit of an anomaly other than Rick's friend, Howard Cooper. I've done 179 investments since 2005, and many of them have, I would say 80% have other families that are on the LP or GP. So I had my staff go out and contact families, first and foremost, that are experts in particular areas. And we had conversations, what they're doing, what they're seeing. That's where my referrals were coming from. And they knew those people because they had already invested. So I wasn't only re-upping, they were re-upping, so I would follow them into the deals. The next thing that I did, because I'm not traveling, is on the diligence side, everybody I ask for references. And when I speak with the references of an LP that have been with them for 1, 2, 3, 5, 10 years, fund one, deal two, it gives me a level of comfort, because even though I may not have seen them, they have met and they have personal relationships. So those two factors, references for me on the diligence side, and family offices, what they're investing into, and people that they know personally, has made a very big difference.
Mhm. Very good.
And then I'm curious, Mauro, do you have any sort of unique deal flow with all of your work with the, with your teaching and working with the different European institutions? Does that open up, sort of avenue that the rest of us are missing out on?
Well, I have to say that the beginning of 2020, I have experienced a slowdown in the deal flow. Recently, in the last, I would say, 4 or 5 months, I have seen a complete change of the operating procedure from the physical way to the online way. So in every level and in every sector, I would say, from the university point of view till the European Commission, going through the family office. Now, I would say that everything is done online. And I would say that in some cases, I am working with clients that I've never met, that I've met just online. We have increased our presence and the way we work also with the social network like LinkedIn. I have at least one of the deal that I'm following that has born on LinkedIn, directly on LinkedIn. Clearly, we have had some Zoom call, but we have never met the client. And also internally, clearly, there is no the possibility to meet. So all the committee that we are holding, both with the European Commission, both with the family office, with the asset management, are done with conference calls. Actually, I am not at the office. I am at home that I have in Italy, even if I'm based in Switzerland, and it's like 1 month that I'm working from here.
Right. And then Rick or Dino, anything you wanted to add on the sourcing and due diligence changes?
I mean, we have always had, presenters by Skype or now Zoom. Our meetings are by Zoom now. It's much less efficient system. People go on and off and they're not as interested, or they're dual scanning. So it's a little more difficult. But I will say the one thing in terms of sourcing and doing deals that I've noticed in the last few months is there is so much more capital that deals are getting closed in a week, that people are throwing money at deals that used to be open 6 months, even a year. Smaller deals, niche spaces, that bigger people are going down market to find, especially on the yield side, to find deals. And we've been locked out of a bunch of deals that I wouldn't have thought would have closed anywhere near as fast as they were, on top of the fact that I thought things would be slower because of COVID, because of the increase in capital that's available.
And to jump in on that point, I was on a conference yesterday with the Association for Corporate Growth, and a lot of people in the breakout sessions were complaining about that, because most of that group, they work in the middle market and lower middle market, and they all commented on the bigger private equity firms moving down market, and that it was mostly for bolt-on acquisition, so there was no way they could compete with them. So I assume that's part of what you're seeing.
But even in smaller yield-oriented deals that you wouldn't see institutional money going towards, we're seeing deals that were like $75 million deals be sold in hours by institutions that we wouldn't have typically seen in prior markets at all in that space.
And then, do you know anything you'd like to add there?
Just the fun fact that you mentioned before about the iPhone going around, people going around to the warehouse with the iPhone and showing what the existence is in the warehouse, or how the office looks like, or something like that. Yeah, that is happening. It's happening to us actually. In a couple of days ago, we did a sort of a virtual visit of the warehouse of company that we are trying to acquire.
Mhm.
Well, and I'm actually right now consulting with a private intelligence firm, and they had their busiest November ever. They primarily work with investors on pre-investment due diligence, and they've got a large network of people around the world, and can find out information in ways that investors don't normally access. So I think a lot of people have been using them and firms like them to try to get more comfortable with groups that they can't go see in person.
Yeah. I was reading also there is a company that provides services with special camera recognition, that they can go in a warehouse and passing the camera to the different articles can count actually the articles that they are on the shelves and all this kind of stuff, and provide a real on-time report of what is there. So it's pretty amazing also the technology, how is going toward that direction.
Can I ask the converse of what Robert is asking, which is how do you evaluate people if you never knew them before? And how do you de-risk yourself from that knowledge that you really don't have the relationship that you used to have with a deal?
Well, there's a company called Kroll. You might have heard of them. They're the largest security firm in the world. I mean, if you're going to deal with people that you don't know and they don't come from a good referral and you can't vet them, you have to be extra careful in this time, because Bernie Madoff made off with a lot of money from people looking slick when people could get to him. So no doubt there's probably some scammers out there. Luckily, I haven't encountered them. But I do think extra care is warranted to make sure, is that camera in a real warehouse, et cetera. But I don't know many family offices that do business with people that either they don't know personally or somebody hasn't referred them in. In fact, I don't know any. Everybody I know is going through somebody that they trust.
Great.
We're very different than an investment bank that will just take a cold call. You know, you have to come in through somebody that knows us, or has someone who will vouch for you that is a reputable person, you know, like Howard or whoever, Barry, for example. It has to be somebody good. I worked from May until now. I've been working with a wonderful family in California that came in through another family office. We did their entire family governance, and it was actually the first time that they had the time to do governance, for example, before they went ahead and did the investments. I think because people aren't running around and traveling so much, it's also a great time. I would encourage any of the family offices out there to get really strategic, because now you have time. Sit down, do those values, do your plan, do your 100-year plan for the family, really get a sense of where you want to go, so that you're not just, you know, running around a store without a shopping list. Actually focus and decide. You know, you can hire professors to consult to you. You can hire all kinds of people to talk to you on Zoom from all over the world about whatever it is you might be interested in, and get very strategic, because now is a good time to do that. People have more time to be strategic. Even though deals go fast, I think it's easier to write a fast check if you know what your sweet spot is and where you're trying to go.
Well, I guess sort of following on with due diligence, as well as, you know, sourcing deals from other family offices, I'd love to hear from whoever wants to take this about how you're currently structuring most of your investments. And is that, you know, a lot of co-investing with other families? You know, does your group or the group you work with tend to take the lead, or are you more follow on? And, you know, again, has that changed at all in this environment? And
I would just say briefly, you know, whoever, if it's going to be a group, the lead should be somebody who has deep industry expertise. That person has the right to be the lead, not just because he wants to get a GP fee. If he doesn't have expertise, he doesn't deserve a GPP, then it shall be coast, in my opinion. And the size of the investment obviously should make sense. I see a lot of families sometimes don't sit down enough and really look at how they're sizing their positions. And you know, better to sprinkle, as Barry said in the beginning, just do a little bit of a bunch of deals and see how they go and get to know the teams. You can't know much of anything until you're in there, and don't take too much risk until you really know the group.
Yeah, Carol, you're absolutely right, because, you know, it's very important to know the group, know the people. I'll go in at a small amount. Even funds. I don't invest into funds, very many, but I will for the co-invest rights on there. Going early stage, I do that to see how the team works, especially if it's the first time team together. And then I can say, okay, I'm going to invest in the next round. Very important to see how they operate together as a team. Individually, they may be great operators, but when you put them together, I want to see how they are. So that's a great point.
And then from our international panelists, I'm just curious if, I mean, I assume you guys are maybe working more cross-border than some of the rest of us. Have you had any, I don't know, additional issues with structuring investments in this environment? Or, you know, as long as you can get on Zoom, it's still worked out okay, as you can review the legal docs?
In my case, just, you know, it dilute a little bit the time of the execution of the transaction, but the transaction get done, even virtually.
And then I think we'd all like to hear about any either recent successes in this environment, or maybe even recent sort of maybe not disasters, but any red flags that, you know, either sector wise or structure, or, you know, kind of good and bad, and, you know, recent stories would be fun to hear about specific deals.
Yeah, I'd love to tell you about this cool deal that I worked on this summer, which was referred to me by another family office. It's a young group of people, the founders. It's an online tech opportunity. The company is called Cluster. And these young guys basically got together and figured out a way to organize volunteering across America and to get people paid by major brands for their volunteering, which is pretty brilliant. So basically, the major brands realize that the Gen Zs and millennials are not responding to traditional advertising, but they are very focused on how philanthropic and how charitable and how helpful are the big brands for real, not just, putting something on their website. So, for example, if you want to do beach cleanups in California on Santa Monica Beach, they'll get Glad trash bags to sponsor your beach cleanup and pay you for promoting Glad to your network. In addition, they have over, I don't know, 300 million eyeballs worth of influencers who are running events. They're starting an event with the United Nations. They're doing an event with the city of Austin, Texas. With San Antonio, Texas. They're doing one with a couple of banks. So it's a really fantastic combination of Hollywood celebrities and influencers, media influencers like Mr. Beast, who have, believe it or not, guys, there's a guy called Mr. Beast who has 40 million kids following him about animal causes. And if he does something on a volunteering event, whether virtual or a live one, because of course all the kids are very live this summer demonstrating and doing all kinds of things, he will get paid by, let's say, a major pet food company or Microsoft or whoever to say a shout out to the company for sponsoring the event. So it's a brilliant company. It's just launching now. I personally invested because I love it. And I found one of my family office contacts, which is a multi-billion-dollar family office out of Mexico. The young next gen guy absolutely loved it, got the family behind it, and they own over 150 stores in Mexico, and they're going to be able to promote events to do charitable work in Mexico via this app as well. So it was a white space, and now they've got Twitter looking to buy them already, and they have barely launched. And a lot of these firms are saying they're so Snow White, they will outsource all their social impact work, the Twitters and the Facebooks of the world, to this group rather than trying to do it themselves, because the kids are very skeptical of the big companies. So that was an example where a family got excited. It was corporately great for them. It was great for the next gen guy, and they became the anchor investor. And we brought in a bunch of others as well, but that one in particular was very satisfying. And I think it's going to really be great. So anyone wants to know more about that, let me, message me or call me, and I'll be happy to tell you. I personally invested as well. I think it's a great company.
Right. Any other recent success stories that anyone like to share, or stories? We got.
I'll tell you success and horror. SpaceX, Palantir, Teledoc were early investments of mine that, because of the time I spent in Silicon Valley meeting those people. The horror story was in Korea, where I was very actively involved, and I really didn't have anybody on the ground. And you can Google the company Yellow Mobile, which I wound up losing everything on. And it was because I really didn't have anybody sitting there at the board meetings understanding what was happening. And this was at the time when you had the Bitcoin cryptocurrency bubble, which then collapsed, which is now back now. The CEO really divested without, board's approval into a lot of areas. So I'm very cognizant now, and I invest into India, Israel, Vietnam. I'm pretty global, but I always make sure, and China, I make sure that I have somebody on the ground to represent and help me there.
All right. And Rick, any good success stories or red flags to share?
It's funny that I would consider myself to be a more traditional investor, but now I guess I am. We're still doing some middle market lending deals. We like CLOs in this market, specialty lending. I've done a few VC deals that have done vastly better than I would have in my wildest dreams ever thought, because of the price inflation that exists at the top of the food chain in companies that have come public from VC, buying lower level companies at inflated prices. So I've never seen anything. As I said to someone, you could take all of the excess that existed in 2000 and put it in 2 public companies today. The excess today is so much greater that I think people should be saying, where are we going to be 7 years from now? Not 2 years from now, because we may still be printing money and we may have a country like Portugal with negative interest rates that could barely pay its debt 4 years ago. Where are we going to be if things even start to normalize? I was never a person that believed in idea companies. I believe in fundamental management and this thing called earnings. And I see there's people who don't believe in that, but I'm surprised, I guess, to my own economic dismay at how people of my generation have bought onto this. I still haven't, and I'm doing fine, but I'm not making 100% returns, and I'm not a Palantir level or Airbnb or Grubhub level investor in terms of my returns. But I'm kind of surprised at how quickly people's frame of mind with respect to investing has changed.
You know, Rick, that's a great point. I just want to add, it's nobody mentioned valuations right now make no sense. I don't care if it's in the private equity sector or in the venture sector. And, you know, you can argue, people can argue with me and tell me that it's worth A, B, and C out of the valley, but you know what? They don't make sense. So I'm very, very cautious in the private equity sector and in the venture sector on valuations. You have to know much more detail, and you have to look way ahead and see where things are going far from now, 3, 4, 5 years. I think Carol made a comment on distressed commercial real estate office. We know it's going to be a disaster in New York City and San Francisco. I don't personally think it's going to happen for at least a year. They're going to get bailed out and bailed out and bailed out. But I'll tell you what, that's one of the best sectors to be in. So I'm spending most of my time talking to very smart people. Please let me in when the time comes. And that's going to be a great area. I'll stop there.
Well, I guess either Dino or Mauro, any recent success investments you'd like to discuss, or also, since we're moving sort of forward, any new areas of interest based on your outlook?
Yeah, maybe I can give you a brief summary of the recent things on which I've worked. The first one is a general contractor company that has collected in a couple of months 1 billion portfolio in construction works related to one of the innovative acts approved by the Italian Parliament in 2020. That is super bonus 100, and is called super bonus 110%, and we believe this is a great opportunity. And it's a 110% tax credit of the expenditure made in order to improve homes' energy efficiency and lower its seismic risk. And there is this is a really hot topic in Italy right now, because government is trying to deliver an enormous stimulus package of measure, and this is one of them. And there is a really strong interest from potential homeowners to improve and to have a package of real estate and construction work actually for free, because the tax credit that is also sellable by the general contractor will cover for 110% the works that are going to be done on that real estate asset. So we believe this is a really great opportunity. The market is the value of this market is thousands of billions of euro, and we believe that it's an interesting opportunity. Another one is a company that we have created. Actually, the name is European Digital Asset Exchange. It's a company that is similar to the SIX, that is the Swiss stock exchange market, is trying to build a platform for the issuing of digital securities. And with digital securities, I mean digital share, digital bond that are going to be issued on the blockchain and that are going to be traded on the blockchain with different and several advantages. Another very good opportunity where I'm working on, and here I'm covered by by an NDA, so I can't disclose the names, but I can tell you the content is an innovation in treatment of the CO2 that will allow to produce biopolymers from the treatment of the CO2. And we already have a memorandum of understanding with one of the leading companies in the industrial and medical gases business. And we have also presented this innovation to the European Commission, and we received a seal of excellence from the European Commission. And we believe this could be a really good opportunity that can see the an IPO in the next 3 to 4 years.
Fantastic.
Right. And then, do you know any successes?
The other is, I think she's really taken.
We got turn Gary off. 1 second.
It would be good for
Yeah, I mean, very quickly, I think we are currently working on getting to the close of a IoT company, the acquisition or investment actually into an IoT US company. This is specifically for the hospitality business. And this company is, we represent a group of families that are investing in a convertible note for this company, and in order to acquire another company that is in the same space in Europe, and they will create probably like a large multinational group that is very specific in a very vertical type of space. And I think this is a typical example of deals that are very interesting now, especially for family offices that have some sort of exposure to this type of to some part of the business. Okay, so most of the investors have or have had in the past experience in this sector, so that's why they were so excited to invest and support this project.
Robert, can I jump in here 1 second? And also, can I recommend that you check out the chat for questions? But so let's talk about 2008. When 2008 happened, what was big in 2009 and 2010 was secondaries, distressed investing, and a lot of family offices went to offering credit because all the banks had, pulled back from lending. Do those still work? Any thoughts on that? And then also, if you guys can talk a little bit about your debt versus equity investments today, like what you intend to do for 2021, because we have some fund managers online. They're asking, are you investing in funds, or are you looking for co-investments? Do you care more about, future rights, et cetera? So if you can address that, that'd be great. And by the way, I just have 2 other comments, which are quick. One is we had a Spanish private equity fund on in September. They said half the companies in Spain are going out of business, going into bankruptcy. The other one is, Barry said New York real estate, but I'm of the opinion that all real estate that's in New York and LA is bad until leadership changes. But maybe you guys have a different opinion. So please take it away.
Well, I will defend New York here. I happen to think that New York is not done. New York, we're back to the levels we were after 2001. I lived in New York then, unfortunately. I've lived in New York since 1984, hard to believe. Currently, I'm in my house in Long Island, but there's quite a bit more life in New York than you hear about on television. Yes, I think it's a little scary that Goldman Sachs is moving their asset management business to Florida, and some of the financial firms are starting to leave. That's kind of scary. But at the same time, a lot of the tech companies are moving more heavily into New York and taking long-term leases. So perhaps New York will just leg down in terms of the overall price expectations, both from the landlords and from the tenants. The taxes are a big issue in New York, but there's still a lot of people and young people that still want to come to New York. So, I just don't think we're quite done yet on New York. Is this the time to buy? Heck no. On the other hand, I've seen some very juicy apartments with Central Park views that you never would have seen on the market before. So there are definitely some people running, and there'll definitely be bargains, but I don't think you can count New York out.
So I'm gonna agree with you, Carol, on that. I think residential is coming in. I'm getting calls all the time, 60, 70% off market for townhomes, which I'm looking at prices in Hudson Yards. Things that I was looking at personally are 60% off market. I'm talking office, I'm talking retail. I don't know how they're going to repurpose them. You got to figure out a way to do it. I was talking to other people that are going to use it for, hydroponic growing for cannabis, which is, logistic centers to cover Upper East Side, Upper West Side, Lower East, Lower West Side. So you can have 4 pairs of shoes delivered to you and back and forth in an hour, which saves a lot of money. So, and the one comment that everybody, and I'm not mentioning names, makes, that's a big real estate developer, says New York is the most resilient city in the United States. I agree. The question is it going to be 5 years, 6 years? Hospitality, hotels. So you're going to have to hold on to these hotels and keep them clean and keep them mold free and keep, that's a lot of cost involved in that. So I don't know what's going to happen with the relocation. I think this WeWorks model coming back, doing an IPO doesn't make sense to me. They're going to have to repopulate and move people into different areas. We'll see what happens, but it's not something quick. It's going to be something years down the road, and New York will come back.
Real quick, Barry. Our earlier real estate panel said that every hotel in the country is moving to a WeWorks. They're all offering office space right now.
Yes.
I'm not sure how viable WeWorks is anymore. You kind of hit it on the nose with duration of investment. Yeah, maybe New York real estate is a great investment in 10 years. Right?
10 years.
But I have no faith in the current mayor.
I agree.
Oh, well, he'll be gone.
And by the way, none of us are that young that we haven't seen many bad New York mayors, by the way, right?
I
Like,
think
we all know that a bad New York mayor is the kibosh on good business.
Right.
So,
And the homeless situation is horrible there.
Yeah.
So that's another problem.
well, San Francisco, LA too. But anyway, keep on
Same,
going,
right,
guys.
same thing.
I asked about secondaries, distressed. I mean,
so for me, I'll just mention secondaries. I love. I play in the secondary space. I don't do distress. The returns are not there for me. I'm kind of a risk taker. I don't do credit. So on the secondaries, I will play in that space on a regular basis, both selling some of my assets. I made the mistake last year of selling in the secondary market half of my Palantir holdings, which I had gotten very early on. I regretted it, but it's part of the game. I didn't think they were going to go public, so it is what it is. But secondaries, I like that space. Just another note, Marty, you brought up is co-invest. I'll invest into funds for co-investment rights. I really am not excited about paying fees. I'm sure most people on the panel are going to say the same thing. I will pay fees if I'm in a region that I don't know. So India, I've invested into this year 1, 2, 3 funds in all different asset classes because I don't know India and I want to be very, very cautious over there. I'll pause at this point.
I mean, I would agree. My families are not doing much in funds unless it's a really big marquee name in terms of people that are just scared and they want security. They'll do a Blackstone or some, extremely large Goldman type marquee name. Otherwise, we look at directs. Debt is tough right now. Obviously, bonds are not very exciting. I would rather be in cash than bonds because there's no way for interest rates to go but up at this point, hopefully. Hopefully, we don't go to negative interest rates. So debt is not exciting. It's kind of scary. But alternative income generation is important. Obviously, all the oil plays have died and they're down 50%. Maybe at some point it's time to get back in, but with, again, lower expectations. I think it's very difficult to have a high expectations of interest bearing instruments right now. That's the truth. You're better off, getting yourself some great apartment buildings, someplace with good tenants, or even Section 8 or something where you're going to get paid.
And Dino or Mauro, any follow up on Marty's Marty's recent questions? And if not, I have a new topic that we've sort of danced around so far. But
not really. I mean, on my side, we have, we do cross-border investments. So basically what we do is to try to co-invest with somebody else that kind of lead the investment. So that's our strategy, and that's how we move here in the US.
Well, what I was hoping to get into a little bit is obviously ESG is a big topic. I think it's like ESG mutual funds are the only ones raising any money. Everybody else is bleeding money. And, you know, I think Carol touched on it with working with the next generation, and then, you know, more with the sort of the clean tech play. So I'd love to hear how you guys are sort of, you know, are you explicitly taking ESG into consideration with your investments, or have an explicit mandate, you know, in different areas there, or is it just, you know, sort of on the periphery? And
in my case, it has become the part of the warp and weft of a lot of the family constitutions and governance now, and with the plans of the family office investments. Certainly, if you have a lot of younger people or women involved, typically they tend to be much more on the bandwagon, but not necessarily so. I mean, remember, it was Justin Rockefeller who got the Rockefellers to divest of oil in the Brothers Fund when it was at $150 a barrel. So that was a pretty good play. But yeah, it's deeply embedded now for a lot of families, and certainly for most of the next gens that I work with. And it's not just fluffy. It's really got to be analytical. It's got to be measured. There are great organizations, including the Impact. There are, you know, Rockefellers are very involved with this. GIN, the Global Investment Network, that sets, there are global standards being set. There are practices and procedures being set. So this is becoming, you know, fulfilling the UN SDGs. All these things are quite analytical and no longer fluffy. And there is definitely a way to make money and also be doing something very positive for the planet. And that makes a lot of people feel good, including me. That's a big focus of what I do.
I couldn't disagree more. In our group, we call ESG egotistical, stupid, and greedy. It's a completely manufactured idea. There is no quantitative measurement. I'm a lawyer. I'm involved in 2 major litigations against companies that portrayed themselves as ESG and are frauds and are not ESG. ESG is obviously in the eye of the beholder. I get solicitations for companies that do life settlements, which are actually hoping that people will die soon, that tell me they're as ESG. Most of them are tricking old people into selling their policies at imperfect prices because they can't do discounted present value, but that's ESG. So I think that the ESG movement has taken off, but if you look carefully, the bigger brains in the US are anti-ESG. The Labor Department, state people who are scrutinizing it, and there is a war coming between ESG, which has no quantitative support whatsoever, where they say there's studies showing that ESG investment is better than non-ESG. That is nonsense.
That's not nonsense.
That is nonsense.
That's not
Okay,
true.
that is completely false. And show me the study, because we've hired someone to do those studies, to look at those studies, and it is nonsense. And secondly, you can't define ESG. I teach securities law and not-for-profit law, and I can't define it. So ESG will either succeed or not succeed, depending on the political environment. It is simply a political movement.
That might be correct, Rick, but I want to kind of skip the ESG discussion and just, you know, leave it with 2 thoughts. We had Maxwell Drever on, who's a famous legendary real estate investor, and he said his ESG was ripping out his wall-to-wall carpets and putting in faux wood into the floors of his apartment buildings, and that was ESG. And then we did an event in Boston 5 years ago, had some of the best healthcare investments around, and they were following an ESG panel, and they said, wait, why isn't healthcare part of ESG, right? But I am pro ESG, whatever makes the world better, I'm for it. So I want to keep on moving, and I hope Robert has some add-on questions. So Robert?
Well, I guess we're kind of getting near the end, so I wanted to almost bring it back to the beginning and reflect back to the first speaker of the morning, Ed Yardeni. I thought I think he talked about how we may be heading in sort of a roaring 20s when we come out of this. And I'm sure we've all seen different reports on, you know, what time is the current time most like from the past. And I'm pretty bearish. So I think we're more like 1930s when we're looking at the 2020s. But I do see that we could have a lot of excited people once we come out of this. So I'm thinking we may get 6 to 18 months of the roaring 20s, and then we're going to be in the 1930s and it's going to be horrible. But I'd love to hear, everyone else's sort of thoughts on that, even though it's a deal panel, but kind of bigger picture to wrap it up here. So you probably each have 2 to 3 minutes or less to opine.
Oh, I'm going to just comment on, on Rick's point with ESG, and then I'm going to jump right in it. I'll give you 30 seconds. I believe ESG became a marketing tool. I became a word for people to say, hey, I'm an ESG fund or an ESG, so invest into me. Okay, I like the Rockefellers. I like what they're doing. As far as on the macroeconomic side and where the world is going, roaring 20s, roaring 30s, I wish I can tell you my next door neighbor for 20 years is Wilbur Ross. He's probably the brightest guy in the world in macroeconomics. Every time I had a question, I would ask him. Unfortunately, I can't ask him anymore. I am the worst person on this panel to discuss macroeconomics. So I'm going to pass on that and give it to Rick, who's probably better than me.
Before we move on, I just want to get an opinion from our European counterparts as well about the state of the euro, European economics, et cetera, when they answer this question, because we don't have a European viewpoint here in the States, but I'm of the opinion that things are tough in Europe. So keep on going. Rick, you're next.
Things are definitely tough in Europe. I'm looking to buy a villa in Tuscany, and every week I get discounts on the stuff I'm looking at. You can't really do a closing now virtually there because of the title. It's not automated like title here, but prices that I'm looking at are basically the same that they were in 1990 in Italy. I think if we came back to this panel in 10 years, people will say that this was the era of VC excess, that venture capital ruined America, because venture capital is the payor of all big deals on Wall Street right now. Lending, management, taking companies public, doing secondaries, okay, is where the big money is being made in traditional investment banking, and then mergers and acquisitions with inflated stock prices, buying startups that may or may not succeed at billions of dollars. Someone said to me the other day they're looking at legal software because software is replacing lawyers. I said, you're right. My legal software recently replaced all of my numbers in billions with numbers in millions with numbers in billions. That's the era that we're living in. And because the private equity people and the VC people carry so much weight, they dictate pricing. So the standards of due diligence, and I can tell you this from my own caseload where I sue companies, I've never seen anything like the level of fraud I'm seeing now. The level of absolute gross misrepresentation, and the lack of careful due diligence or analysis at every gatekeeper level. I've never seen anything like it. Even in the 80s, I didn't see anything like it. So I think 10 years from now, we'll look back and we'll say they were villains. These guys were bad guys. They were robber barons, and we suffered for it. We have never been in an environment ever since the beginning of mankind, according to the Fed governor who we had speak last week, where rates were this low. We have negative interest rates in countries that have bad credit. How do we unwind the $300 trillion of debt that's negative to zero to a few basis points? None of you ever thought you'd mention the word basis point more than once a year when you were in business school. And now we talk about basis points as if they were fundamental to the economy. A zero interest rate environment leads to bad results. We're going to see those bad results. Right now, the result is money's flowing into crazy equity deals because people don't want to take risk on bonds, like Carol said, and that's absolutely sane. But someone owns $280 trillion of debt that will not perform over the next 10 years.
Hey,
That's
Rick,
forcing money into the
Rick,
equity market.
One question, Rick, are the villas in Tuscany in 10 years going to be priced in euros or lira?
I think the euro will survive.
Can we let our European panelists comment before we're done?
But for the life of me, Mauro, why do you guys want the euro to inflate?
They probably have a little more view on Italian. We have two Italians on the phone. Let's hear from them. Mauro and Dino, can you say something?
Yeah, sure. So just one thing about ESG, because I spoke about one project that probably is in this field. And what I think is not about, I mean, I don't think here the point is about the fact that ESG has a premium return over similar projects or companies that are not ESG. I see the possibility also inside also working inside the European Commission. I see there is a really strong focus on this type of projects, on pollution, on social responsibility, on energy saving, and so on. What I see is a really big opportunity, because a lot of public money and many legislation around the world are focused on this kind of a field, on this kind of problems, on this kind of challenges. So I think there is a huge opportunity if I find a project that takes the opportunity of the carbon credit and makes money from this opportunity, like the one that I presented at the beginning. I do not really care about the possibility, or I do not make the question to myself if ESG is better or not than an alternative project, ceteris paribus. But I just see the opportunity to invest in a company that could be a multi-billion company in 5 to 10 years. So this is my point on ESG. About the macroeconomics, I think that central banks all around the world and also in Europe have been delivering an enormous stimulus package. There is a lot of liquidity around. And I'm a little bit worried, actually, because this amount of liquidity is summing up with the liquidity that was already huge before the pandemic and the COVID crisis. So I do not know what is going to happen in the future. I see what is happening on the stock market, and the reason to buy a stock because somebody else will buy the stock in the future at a higher price usually is not really a good reason to buy a stock, I would say. And the last thing is that the economic history is teaching us that liquidity has always been at the beginning of every big crisis. Also, the last one, subprime, the subprime crisis has started because the Fed injected a lot of liquidity, and this time the problem seems to be much bigger. So actually, I'm a little bit worried about, even if I do not have the newspaper out tomorrow to tell you what is going to happen.
I'm on a family office tomorrow.
Nina, what about you? You got something there?
On the macroeconomic view, I agree. I agree with Mauro. I see that. I mean, the huge liquidity on the market, it really it scares me a little bit. And but at the same time, the situation has been dragging for a while like this. So I don't know what and when is going to happen something. But having said that, I want to come back to the other subsidized type of, let's say, investment, which to me it's another job. I mean, it's really different from what I do, and I don't want to give an opinion in something that I'm not prepared to do. But it's a highly specialized type of product, type of asset class, especially when you have to structure it. And when I was with Banco Santander, we used to do a lot of renewable energy financing, and the complication of structuring this type of asset class, it was quite challenging, not only challenging because it was complicated, but also because it was changing and the legislation constantly changed, and depending on the country involved also, it changed again the whole situation. So I really don't have too much of an opinion here.
Any other comments? I think that's a wrap because we're just out of time for this. But you guys have had a really fantastic panel. I love the fact that you guys all have opinions, but somehow I bet you could all work together if you had to for one thing or another. So that's really great. And Robert, again, as always, fantastic discipline having to listen to us. So thanks so much, guys.
Thank you.
Analysts.
Happy
Thank you.
holidays, everybody.
Way to go.
Thank you.
Take
All
care.
right, perfect. Thanks
Thank
so
you
much,
very
guys.
much.